Welcome to our channel, and more importantly, welcome to our first educational episode where we will be analyzing the fundamentals of the gold market and coming up with long-term targets for the world's favorite commodity. Everything I will be discussing in this video is a function of my own opinion based on the research and quantitative analysis I have done analyzing the market. Stick around to the end of this video and remember to drop a thumbs up on this video and subscribe to our channel if you like the content. Also remember to turn on our channel notifications so that you are notified every time we upload a video. Follow us on social media to keep up with our educational content and so you never miss any important market news. All important links to our channels are in the description below. Let's get right into it. So we're going to start off with a little bit of a history lesson, and essentially in 1944 the Bretton Woods standard was established where 1 ounce of gold was pegged exactly to 35 US dollars, making the US dollar the world's first and only reserve currency. So what did this mean for other countries? Well, let's take the UK for example. In 1965, £1 was equal to exactly $2.50. So rather than holding their reserves in gold, the Bank of England would hold their reserves in US dollars and redeem them with the Federal Reserve Bank in exchange at a later date. However, in 1971, President Richard Nixon removed the US from the Bretton Woods standard due to the increasing number of US dollars being shipped to foreign countries through trade, since the US economy was expanding and purchasing lots of goods from other countries. This was problematic for the US government because at some point they would have to exchange those US dollars for solid gold, which their reserves were running dry. This resulted in a huge increase in the price of gold relative to the US dollar, subsequently causing a crash of the value of the US dollar. However, the US dollar remained a reserve currency, and this was respected as every other country had essentially left the gold standard themselves. I found a great article on the gold standard and the Bretton Woods standard on thebalance.com, and I'll leave a link to the article in the description below. It's a great read and I definitely think you guys should go through it just to have a little bit more clarity on what we was talking about earlier. So let's get into our analysis. So we want to know what is causing these massive exponential rallies in gold, so we have to look into the history in order to find out why this is happening. So we have the 100-year historical gold price chart so that we can analyze price and see what happened in those periods to cause those massive rallies. So as you can see, our first massive rally happened when we depegged from the gold standard, and that rally lasted between 1970 and approximately 1980. The second time we can see clearly on this chart is from 2000 all the way up to 2012, and you can see we've sort of started one since 2015 and we're still continuing to go up. But let's justify why these rallies are happening. There's actually a third time that this has happened in history, and it's actually back during the Great Depression of 1929. Even though currencies were pegged to gold, there was still a huge spike in the price of gold from $20.78 to $35 because countries temporarily depegged their currencies to the price of gold in order to fund the war, and they would have went into huge amounts of debt if they didn't do so. So they purposefully devalued their currency in order to do that, and that was another time. So we're also going to be taking a look about what happened during that time in order to cause the price to have to go up so rapidly. So the only real index that existed at the time in the US was the Dow Jones Industrial Average, and as you can see we have a price chart that goes from 1897 all the way up to current day price. So let's look at these times in history where we analyzed gold having massive rallies, and I've actually did a little bit of a job here and I've highlighted those areas so that we can see clearly what's happening with price action in stocks during the time that gold is having a massive rally. So as you can see here, between the 1970s to the 1980s, price in the stock market was trading sideways and not really making any significant gains, but the price of gold went up exponentially during this time. Similarly, during 2000 all the way up to 2012, if I extend this line here a little bit further, you can see that similar price action happened, but this caused a massive exponential 600% gain in gold during this period. And now we have where we are currently in 2020, looking like we're forming a similar pattern. So this is a big thing that we're going to use in our analysis to determine what the next price target for gold may be, because we're seeing similar price action. And as you can see here in 1929, as I'm going to highlight using this box now, was actually a massive sell-off in the stock market that actually caused the Great Depression. So we've established a few things here. We've established that gold has massive rallies when the stock market is either crashing or trading sideways. But I like to call this type of price action uncertainty, because no one really knew what was happening here. It was very uncertain. So during times of uncertainty and during times of huge massive market crashes, gold tends to outperform the market heavily, seeing these huge rallies. And if we just simply look at price action here of where we're at now, even though we're trading near all-time highs, there's still a lot of uncertainty in the market, because as you can see from a lot of the economic figures and a lot of things in the news, even though the stock market is rallying, it is very questionable about how long this rally can be sustained. So if there's any fall off in the market or any sideways trading, this is a very, very positive thing for gold. So you may be wondering, why does gold perform so well during times of fear and uncertainty? Well, let's take a look at how investors may be thinking during these periods. On this chart, I have plotted a graph of the total money supply versus the stock market, and as you can see that even during times of economic stagnation, the money supply continues to rise, which causes inflation. So rather than have their money stuck in assets, not having or not making any gains for them, they put their money into gold because gold is inflation proof. Gold is essentially risk insurance, and it retains its value through recessionary periods and times of economic stagnation, because unlike cash that can be printed in large quantities whenever the government and central banks feel like it, gold is only mined at a fraction of that rate and cannot be printed by the government. Governments and central banks are also some of the largest holders of gold reserves in the world, just in case they need to service their debt, and they understand as well that it is inflation proof. This is another factor that makes gold the asset of choice when there's uncertainty and fear in the market. So investors load up on gold when they know that the economy is slowing down. But during times of economic expansion or economic growth, this extra liquidity provided by inflation makes its way out of gold and into the market, causing these massive rallies that we have seen over a period of time. So if we look back, we can see that during this breakout period, I can almost guarantee, if we look at the gold chart, that the price of gold was going down as we embarked on this massive 20-year rally. And the same thing would have happened here at the end of 2012, between 2012 and 2014, during this breakout, that money would have moved from gold back into the stock market, causing the price of gold to fall again. But here in 2020, we know the gold price is going up in anticipation of another market correction. So let's confirm our theory. So if we look back at our gold chart and we check around 1983, we can even see that the gold price have fallen before then in anticipation of the market recovering. So at this point in time, money left gold and made its way into stocks for a whole 20 years before it piled back in again during the next time of uncertainty, and exactly at the time when the tech bubble burst. And this money stayed in gold all the way up until around 2012 to 2013, where we was also looking at in the chart when there was another recovery or somewhat recovery from the markets and the money started to move back into stocks again. But now here in 2015, in anticipation of another recession, you can see money moving back into gold. And even though the stock market was rallying during this time, you can see investors hedging their positions by entering gold. And this gold run has only been accelerated since the onset of the 2020 recession, as highlighted here. If I blow up this chart a little bit better, you can see that when we did get hit in February by the thing I cannot speak of on YouTube, we can see that gold moved up exponentially even faster, and now we're having a little bit of a pullback. So depending on what investor sentiment is right now will determine where gold goes from here. And investor sentiment right now is actually very fearful. A lot of big investors and big money are fearful. So there's almost no doubt in my mind that because of this fear, we could see a 2008 like scenario replay itself, where we have a dip during the recessionary period, and even after the recession was done, according to this chart, the gold price continued to rally for another 4 years. So that may mean that we could be seeing potentially another 4-year rally in gold from where we are right now. So you may be wondering how I'm so sure that investor sentiment is currently fearful. Well, if we take a look at one of the most widely used indicators by institutional investors and hedge funds, the Buffett indicator, we can see that right now we are currently in extremely overvalued territory. Anytime we have reached above overvalued territory, we've always had some form of correction to bring back the market into either fairly valued or undervalued regions. So if we look back to the 1970 to the 1980 region, we can see when the market had a correction from 87.1% to 32.2% market cap to GDP, that this was also the period when gold went on a massive bull run. Similarly, from 2000 to 2012 around, when gold also had its other rally, we can see that the market also had a correction from overvalued or extremely overvalued into a fair valued region. And since we're sitting at all-time highs now, a lot of investors are expecting the market to have some form of correction to bring us back down into a fairly valued region. Maybe not as far as undervalued, but definitely into a fairly valued region, at which point gold will go on yet another bull run and take us to all-time highs. And we don't have to go very far to see exactly what large investors and hedge funds are doing with their cash. According to Bloomberg, Warren Buffett, the creator of the Buffett indicator, is sitting on the sidelines with over $130 billion of cash waiting to deploy into the market when it becomes of a fair value again. And for the first time ever, we're seeing Buffett buy into gold. Buffett has never been a fan of gold, as he believes that it has no intrinsic value and doesn't produce anything. But we've seen Buffett pour billions of dollars into a gold mining company in preparation for what's to come. If this isn't an indication that something may be happening in the gold market, I don't know what is. And Buffett isn't the only one who's purchasing gold. Ray Dalio, the owner of Bridgewater Hedge Fund, poured almost $500 million into gold in Q2 alone. And it looks like they're getting ready to make another large purchase of gold, because they understand that in order to hedge inflation during these uncertain times, they need to be in gold. If you study his philosophy, you will always see that whenever he moves into gold, typically there's some form of correction in the market. Furthermore, we've also seen the largest contraction in GDP to date, even more than what we saw during the 2008 and the 2000 financial crises. So that just goes to show that at some point the stock market has to catch up with the economy, unless we miraculously get some form of economic recovery that's going to be a V-shaped, as we keep hearing about. But my bet is that's not really going to happen. This is further exacerbated by the fact that we're printing more money than ever. As you can see, we've got a steep increase in the amount of money that's been printed just within the last 6 months alone, adding to inflation, which also helps out gold as well. So even though we were printing money before, we've never printed money at the rate at which we're doing right now. And this money printing is all due to the Federal Reserve. The Fed has poured money into the markets, and the money is going to go somewhere. And when the stock market comes down, it has to go into something else. And my bet is that's going to be gold. And if printing more money than we ever have before in March wasn't enough, we're about to print even more than we ever have before once again, with another stimulus bill of between 1.8 trillion and possibly 2.5 trillion passing sometime in the next couple of months. That's going to add even more to the money supply. Now that we've gone through the background on why I think gold will be going on a massive rally very soon, let's take a look at some of the previous price action data and do some math and figure out just how high we think gold will be going on this next leg up that we're in currently. Looking back at our gold chart, we can see the type of gains that it had. From 1970 to around 1975, it gained around 483% before having about a year correction of 38%. This correction was followed by another gain of around 601%. The next correction saw a drop of around 60%, but this happened over a period of around 20 years. And then that correction was followed by the largest rally we had seen to this point of 663%. Gold then saw another pullback of 39%, and this leaves us at the point that we're at now, where we've begun the next leg up. But it's a good thing we can do a little bit of math and try and make a prediction on what will happen on this leg. As you can see here in this table, I've collated all the data that we just went through, and based upon doing a little arithmetic, I've calculated that we could see up to about an 820% gain in gold, which would leave us with a price around $8,760 between 2023 and 2024. And as crazy as that may seem, it's actually quite realistic to think that it could reach these levels because of the increase in money supply that we've seen over the past few months has been more unprecedented than ever before. And that money has to make its way into something. And if the stock market has a correction, that money is going to make its way into gold. Having now established our long-term target for gold, how exactly do I think this will play out? Well, as you can see, during our last major rally, we did have these significant pullbacks in between as we made our way up to the high. And I don't think that this time is going to be any different, as you can see that right now we're in our first major pullback of this gold bull market, but I don't think that this will do anything to stop us from reaching our target. The only thing that may put a stop to our overall gold target of $8,700 is if the government bans us from buying gold, although I think that this will be highly unlikely. Additionally, if the economy does actually recover, and I'm not talking about the stock market, I'm talking about the actual economy, then that could shift money from gold back into stocks. But I really think that that's not going to happen at this point because, as you can see, the world is in economic turmoil and a lot of economists are expecting us to go into a depressionary period within the next 5 years. With that being said, there's a lot more that I could discuss that supports gold going to all-time highs. But in the interest of time, I'm going to keep this video short and end it right here. All the stars seem to be aligning themselves supporting a massive gold bull market, but of course everything that I've shared is just a product of my own opinion. Thank you to all who took the time out to watch the video, and an even bigger thank you to those who made it to the end of this video. I aim to continue to develop these videos and bring high quality content to the channel, and I plan on releasing one of these educational videos per week in addition to my usual market breakdown. If you haven't already, help us out by dropping a like on this video and subscribe to our channel so that you don't miss out on any of our future videos. Thanks and peace out.